Hello everyone and welcome to another options trading educational video from OptionsPath. Today we're going to talk about some of the best ways to earn income through options selling strategies. A lot of times when you hear about trading options, it's usually presented as a way to take advantage of expected or predicted moves in a stock using less capital and less risk than trading the stock itself. For example, you'd buy a call if you thought a stock was going to rise, or you'd buy a put if you thought a stock would fall. To buy a call or put costs a lot less than buying or selling short the underlying stock. Most of the time, the cost of the option is just a small fraction of the cost of the stock itself. And the rewards of buying calls and puts, if you're right on direction, are potentially huge and theoretically unlimited. Now, buying calls and puts is indeed a great alternative to buying or shorting stock. We opt for trading the options every single time. And in fact, we buy calls and puts frequently when we have strong directional opinions on stocks, ETFs, commodities, or market indexes. With that being said, though, our daily bread and butter trading strategies revolve around selling options to earn premium as opposed to buying options. Why is this? Well, it provides a very effective and forgiving way to receive regular income in the markets, providing us with a strong foundation for our daily, weekly, and monthly trading. So why do we love selling options and earning premium income so much? Well, first of all, we've built long-term streams of income through selling options that are both safe and reliable. And who wouldn't love that? And while we do buy options when we have strong directional market opinions, it's much more difficult to be consistently profitable trying to predict where the market's going to go than it is simply selling options for premium on a regular basis. Now, when I talk about selling options to earn premium, I'm not just referring to simply selling calls and puts and calling it a day. Much of what we do involves selling spreads, which are partially hedged or protected positions that guard against runaway market moves and protect against large losses. In this video, I'll provide some of our top methods for earning premium income through selling options. But before I get to that, just a quick rundown of the basics of options selling and its advantages. Number one, when you sell options or spreads, you immediately earn income in the form of what are called premiums, which are paid by options buyers. Number two, as an options seller, you act as an insurance company of sorts. Most of the time when you sell options, you're betting that the underlying stock, ETF, or index won't move beyond a certain price point within a limited period of time, which is the duration of the options contract. The options premium you receive can be thought of as similar to insurance premium. This can recur as regular income that you continue to collect on an ongoing basis. Also, like an insurance company, if it happens that what you're insuring against actually happens, all is not lost. You can adjust your position by the use of reinsurance, or in this case, by hedging, rolling, or otherwise managing your position. Selling options is very flexible and very forgiving. Whereas options buyers generally need to be right on the direction of the underlying in order to profit, whether the chosen direction is up or down, options sellers are allowed a much greater error of margin. In many cases, the underlying stock or ETF can stay flat or go up or down within reasonable limits, and the full premium income is still earned. Number five, as an options seller, the passage of time works in your favor. As options get progressively closer to contract expiration, premiums rapidly deflate, which is a tremendous benefit to options sellers and a disadvantage for options buyers. Number six, option sellers can choose strike prices that provide a very high probability of profit, which in this case means earning the premium. Generally speaking, the further away the strike price is away from the current underlying price, the lower the premium earned, but the higher the probability of actually earning that premium. Likewise, the closer you choose to set your strike price, the higher the premium, but the lower the probability of profit. Number seven, traders can structure their option selling so that premium income can be earned on a very regular and predictable basis, and this is why selling options is such an important part of our trading. Now, there's a lot more to selling options for income than what I've just outlined. I've just discussed some of the most important aspects. Okay, so now that we've covered some of the benefits and characteristics of option selling, let's talk about some of our favorite ways to actually do it. Keep in mind that these are our preferences and may differ from what other traders prefer. Also, this list is in our general order of preference, starting from the most preferred, though much will also depend on prevailing market conditions, the underlying market we're trading, and our views and analysis at any given time. With that in mind, here we go with our top ways to earn options income. Number 1. Overall, we're big fans of the credit spread, which is the defined risk options selling strategy that we use on a daily basis. Check out our other videos specifically dealing with credit spreads. Of the two types of credit spreads, the bear call spread and the bull put spread, we usually like the bear call spread slightly more. But again, it depends on specific market conditions at any given time. We only like bear call spreads a bit more than bull put spreads because markets tend to move faster to the downside than they do to the upside, although of course this isn't always the case. We generally have several different bear call spreads on at all times on different underlyings. The bear call spread consists of a short call with a strike price above the underlying's current market price and a long call with a strike price above the short call to act as a partial hedge or reinsurance, as I mentioned before, and this is to protect against the event of a runaway upside move. The goal of the bear call spread is for the underlying's price to expire below the spread's strike prices. Of course, as mentioned, the bull put spread is the other type of risk-defined credit spread. We also often have several of these on at any given time. The bull put spread consists of a short put with a strike price below the underlying's current market price and a long put with a strike price below the short put to act as a partial hedge and guard against the event of a runaway downside move. The goal of the bull put spread is for the underlying's price to expire above the spread's strike prices. Again, we have another video explaining credit spreads, including the bull put spread, in more detail. The iron condor comes next. It's made up of a bear call spread above the market and a bull put spread below the market at the same time. The goal is for the underlying's price to expire between the two spreads. This strategy can double the premium received from just a one-sided credit spread at the same margin requirement as that one-sided credit spread, but it also increases the risk of the trade being threatened. Although we don't always pair up our credit spreads with the other side to form an iron condor, we do it often enough that we usually have several different iron condors on at any given time. One of the biggest advantages of iron condors is that because the underlying cannot expire at two different prices at one time, the margin requirement charged by brokers is on only one side as opposed to both. This is provided, of course, that the underlying, the expiration date, number of contracts, and spread strike widths are the same for both the bear call spread and the bull put spread. If you want to learn more about iron condors, check out our other video devoted exclusively to this strategy. Number 4, this brings us to selling cash secured puts. You can earn very high premiums for selling or shorting puts with strike prices below the current market price. The goal of the short put is for the underlying price to expire above the put's strike price. Shorting puts is also a great way to acquire stocks and ETFs while earning premiums and lowering stock ownership cost basis at the same time. If you want to learn more about selling puts, we have a couple of videos devoted to this strategy. Links are in the description area below. Number 5, if you already own individual stocks or ETFs, a great way to earn income as you hold them is to sell covered calls on them. This can be done over and over to create a stream of premium income over time on the stocks or ETFs you're holding anyway. And finally, the short strangle consists of a short put with a strike price below the current market price and a short call with a strike price above the current market price. The goal is for the underlying's price to expire between the two strike prices. It's somewhat similar to the iron condor, only strangles have undefined and theoretically unlimited risk due to the absence of the long options to partially hedge large market moves. However, taking on this undefined risk is rewarded with much higher premiums than can be earned with iron condors. If you want to learn more about strangles, check out our other video devoted to this strategy. Now keep in mind that there are many other option selling strategies for earning premium income, some of which are much more complex and or entail significantly more risk. The 6 strategies I've mentioned here are simply the ones we found to yield the best results over time, and which play major roles in our overall trading approach. Hope you found this video useful. We'll have plenty more instructional videos on trading options going forward. From all of us at OptionsPath, thank you so much and have a great day.